Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. When expectations rise for the market and the economy also rise, many strategists first look to review macro. Joining me to discuss is Matt Lloyd, Chief Investment Strategist at Advisors Asset Management. Matt, it's great to have you with us. Welcome to Trade Talks.
Thank you for letting me be here.
And Matt, strategists look at macro conditions on a historical basis, but you believe due to the current environment, it requires more of a nuanced view. Tell us about that and some of the key metrics that you're taking a look at.
Yeah, I think economists and market strategists were always looking at historical patterns to try to give us a better clue about what the future might unfold. But you can kind of get trapped and go down many rabbit holes when you look at current conditions. Two certain aspects that right now that jump out are the unemployment rate and you look at personal consumption. Both of those are at 40, 50-year oscillation highs that we've never seen before. In fact, personal consumption actually had a trading pattern of down 16 sigma, which is a standard deviation of 16 times a normal expectation. And then it rallied back the next quarter and it was up 8.5, which is about 10 sigma move. The reason that comes into play is if you look at it historically, you really can't extrapolate what this really means in patterns moving forward. So what it means is you have to take a nuanced view, meaning you have to use more schoolyard versus classroom analysis, and it's more artistic than it is scientific. As such, you've got to look at, spreads on the yield curve. You got to look at marginal gains in consumer confidence, lending standards. You have to take a look at a lot of different variables and then try to kind of cut through all the crud, if you will, to come up with a kind of a lucid estimate about where we might be. But I think most people are getting stuck in the rabbit hole trying to extrapolate past conditions for this historic condition we're in right now.
The Fed and global central banks have also acted in unprecedented ways as a result of COVID-19. Do you think they reacted accordingly?
I think so. I think this was a different situation than they've actually ever experienced in the past when we've had to have stimulus put into the economy. And for example, if you look at the 07, 08, 09, the great financial crisis, when Lehman Brothers went under, that became what was really a global bank run, so to speak. And as such, the Federal Reserve and the banks around the world had to prop up the financial system. And as such, that took a long time for that stimulus money to work through the economy. Whereas in this point, the financials were actually in much better condition. And as such, that money went right into the stimulus in the economy. And I think you have to take a look at the overall economic output, and you have to take a look at really what the stimulus is. Total stimulus all in and everything is probably about 3.6 trillion all in. The total economic output lost was roughly about 2.4, 2.5 trillion, even estimates 2.7 trillion. So we've had more stimulus kind of work its way through the system, maybe not as efficiently as anyone would like, but much quicker than we've ever seen. In fact, the Federal Reserve basically took over Warren Buffett's role that he usually does when situations get dire and there's an injection of capital needed. And that's why you didn't see Warren Buffett and Berkshire Hathaway really able to kind of get the conditions they normally would expect, because the Fed basically took that role over.
What are the consequences of this massive stimulus effort, and how concerned are you about liquidity?
Yeah, massive concerns about liquidity in general. Those are the events you really look for. However, the liquidity situation is much better now than you would normally expect because of the accelerated rate that the Fed was and the government were able to get the stimulus in there. What you have to be worried about is the proliferation of debt. It is so massive on a scale that we have not seen before that what are the dire consequences? And so modern monetary theory is telling us, oh, we can get through with this. But there are long-term ramifications. And again, a lot of it has to do with synthetic functions, like the yield curve shifts outward because there's so much supply out there, even though the Fed is anchoring the short end. That's why you probably look at the swap market relative to the Treasury curve. The other aspect is, what does this mean for inflation? Because it's not just necessarily the amount of monetizing and the amount of proliferation of the debt. It's also, there's a shift globally into the supply chain, maybe not domesticating the supply chains, but maybe diversifying the supply chains, which is going to be somewhat inflationary. And if that happens, and if you see the populism type votes that have happened kind of continue, you will tend to see a little bit more inflation than what we've seen before, because that kind of puts a hinder in globalization and how disinflationary that has been. So you really have to be concerned longer term on inflation. My guess is what I'm estimating is probably by about mid next year to September of next year in 2021, that's when you're going to start to see the year-over-year synthetic adjustments to inflation start to perk up. That's when the Fed will probably start to act to move the short end off of such low rates it is now, because the inflation rate normally after a break even gets as low as it did, usually rises about 3%, roughly about 15 months later, and that would be roughly the fall of next year.
Yeah, that's a really interesting point, Matt. And many investors also believe this recent run-up that we saw in stock valuations is a repeat of the late 1990s and even perhaps the global financial crisis. Is the marketplace and consumer behavior very different than it was then?
Yeah, it's really interesting because if you look at some of the metrics of like technology in general, we can use anecdotal where we're looking at business plans and not revenue, and we don't worry about profits. We're worried about market share or monetizing ad revenue. It's a little bit different now because technology now has permeated everybody's life much more so than it did back in the late 90s. And so you have to say that this run up in technology is both maybe a bit natural and unnatural at the same time, meaning the relative chasing euphoria of the big technology companies is higher than it was back in the 90s. But the overall technology sector as a share of the growth and the run up in the late 90s isn't as dire as it is now. So there's a little bit of Darwinistic behavior to it. And so as such, you have to be a little bit more trading technology than you would be an investor in it. You may have to try to say, hey, I have to have some stop losses in my technology holdings just because historically you have seen rampant corrections. However, it's also a time to try to mitigate some of the correlation in the run up in growth versus value is to say, hey, maybe I should dial down the volatility of my portfolio by increasing some value, increasing some European holdings, looking at emerging markets as a hedge on the dollar. Those are things you want to do that might mitigate overall returns, but hopefully what you're trying to do is also mitigate risk and volatility, which right now with the uncertainty that's out there is probably a good thing. Most people take a little bit subdued return for a little bit less volatility.
All right, Matt, appreciate the insight. Thanks so much for joining us on Trade Talks.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.